Good afternoon, ladies and gentlemen, and welcome to the FILTA Group Holdings PLC interim results presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question, and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via Investor Meet Company dashboard, and we will notify you once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Jason Sayers, CEO, and Brian Hogan, CFO of FILTA Group Holdings PLC. Good afternoon.
Afternoon, or morning and afternoon. I'm over in the States. Welcome everybody. Do I click that? Do it later. Okay. So we're FILTA Environmental. Many of you already know us. We service commercial kitchens. The best thing about our business is we have regular repeat revenues from those customers. Our industry was hit pretty hard by COVID. And at our last presentation, we were expecting things to recover and talking through it. We're now living and breathing that recovery, and it's still going. We've got a lot of momentum going. We're now at levels of revenue consistently where we were before COVID. So the story's pretty good. I'm here today. I'm CEO and co-founder of the business, and you've got Brian Hogan here, who's our CFO. Both of us are based in Orlando, Florida, but today Brian's actually in the UK, and our office is in Rugby. We've made it over there. So a little bit of a summary. I started the business in the UK in the late 90s, and I came up with the idea for FILTA Fry, a fryer management business. We expanded this through franchising in the UK, but the obvious market for our services was the US. So in 2003, I came to the US with my business partner to grow the business here. We now operate in the UK, North America, and Germany. We have two primary businesses, FILTA Fry, where we take care of customers' fryers and cooking oil, and then a grease management business in the UK. We service well over 7,000 commercial kitchens every single week, and we deliver the fryer management service through a network of 189 franchise owners who pay monthly royalties and fees. And we deliver the other kitchen services through around 50 company-operated vans in the UK. Both provide us with very fixed revenues, repeat revenues, and the historical and future growth comes in a small way from new franchise sales. Most importantly, our existing franchise owners expanding and our operational business expansion. We're positioned well now to take advantage of the sector recovery that we're seeing. Just flip ahead. So operational highlights. The story really has been the sector recovering for us. Q2 growing well over Q1, giving us the momentum heading into the second half that we're seeing now. We had 8 new franchise sales and 7 resales in the period. And importantly, 13 new MFUs, that's mobile filtration units, sold to existing franchise owners. So beginning of the year, expecting to see growth. It ramps up more quickly than we thought in the US. We had a couple of supply chain issues getting new machines built because we had to turn that back on. So there was even pent-up demand coming into the second half when our machines eventually got here in August. So things have been exciting and growing quickly. The Cyclone GRU, that's a grease recovery unit that we introduced last year, has now been specified by many major chains and is growing well. And overall, our recent initiatives are driving efficiencies and accelerating the momentum of the business in the second half now. So a little bit about the services. Let me explain what we actually do with the graphic of the commercial kitchen here. Everything we do is focused on high margin recurring revenue from that customer base. So FILTA Fry, which is the service provided by franchisees, primarily in North America, cooking oil filtration and fryer management service. Problems in kitchens include high oil use, poor quality food, hot oil accidents, slips, falls and burns, insurance claims. FILTA Fry solve these issues. We have a weekly service, weekly, once, twice, 3 times a week, where we come to site, wheel the machine in, suck the oil out of the fryer, filter the oil, clean the fryers, and pump the oil back in so the customers can reuse that oil. At the end of its life, eventually the oil does come to the end of its life, we take it away and sell it to make biodiesel. The cost for the customer is normally recouped in oil and labour savings, especially now because the price of cooking oil has doubled in the last year. And the competition is principally the in-house employee doing it himself. We have 468 trucks on the road performing this service, again, primarily in North America. FILTA Fog, another one of our core services, is fog management. It's fat, soil, and grease. So washing up dishwashers and floor cleaning carries a lot of fat, soil, and grease into the sewers. This leads to blocked drains, the kitchen, and fatbergs for the main sewer system, blocking them permanently. We install GRUs, grease recovery units, under sinks that separate oil and water before it travels down the drain. We have the best performing equipment on the market. We then sign contracts to clean and maintain these units monthly or quarterly, providing ongoing service revenue for us. All in all, it keeps the customers compliant with the ever-increasing water authority enforcement we're seeing in the UK. FILTA Seal, another one of our services. The same customers have fridges. Those fridges have seals. These seals wear out and need to be replaced every year or so. Typically, when a customer has to replace a seal, we call the refrigeration company, who comes in, looks at the seal, measures it, orders the seal, comes back to fit it. Time-consuming and expensive. In 2010, we bought the patent to some equipment that allowed us to turn up on site, measure the seal, manufacture it in the van, and fit it all in one visit, providing great service and saving the customers time and money. Again, it's all to do with keeping the customers compliant with health and safety regulations. Smaller business for us is FILTA Pump. The same customers have pump stations for pumping waste off site. We install and service these, keeping customers compliant. And FILTA Vent, we introduced the automated vent cleaning system last year. Very early days for this. We're just rolling it out for our first small chain in the UK, but we hope to roll this out in the coming years through our existing customer base, once again, keeping them compliant with fire regulations. So how does all this fit into our business model? We have 4 segments of revenue: franchise development, fryer management, equipment sales, and site service. Franchise development is the one-off fees we get from selling a franchise, primarily in North America. Then we have fryer management. This is the repeat revenues we get from franchisees who perform the fryer management service. We provide a lot of support for our franchisees: sales, tech recruitment, accounting, marketing, technology. And we generate fees in several ways. Fixed royalty per machine that's out there, and that comes into us. And then supplies and waste oil we make margin on as well. The blue on the left there is the franchise business, primarily in the US. The green is company-operated vans in the UK. We sell equipment, GRUs, vent systems, and one-off. That's equipment sales, one-off revenue. The aim is then to generate service revenue off the back of these installations. That's site services. GRU servicing, seal replacement, vent servicing, pump servicing, and to a lesser extent, the COVID protection service we introduced last year. The recurring revenue part of our business has continued to grow year on year, apart from the COVID rate, represents over 85% of our revenue. What I'll do, I'll quickly hand over to Brian to talk about some of the numbers.
Thanks, Jason. The group results for the interim really reflect a business that is in a much different place today than we were 6 months ago and certainly 12 months ago. We're extremely pleased with the progress, our first half performance, and I think more importantly, the continued growth we're seeing as we advance through the third quarter. Broadly speaking, the interim results reflect the significant positive change we're seeing in our operating landscape, and we believe we're well positioned to finish the year strongly and meet full year expectations. More specifically, the impacts that you can see on the slide reflected in 17% revenue growth to just under 10 million, and likewise a similar growth in gross profit to nearly 4 million pounds through the half year. Adjusted EBITDA was up almost or just over £1 million to 1.3 million. And we've been able to maintain and actually grow gross margins at the segment level through this recovery, and that will really benefit us as the higher volumes begin to kick in even further as we proceed through the following months. If I take you to the next slide, it is again just a view principally of the product and service revenue analysis and a cash and net cash net debt position that I just want to touch on briefly. Our ability to manage cash and liquidity through the last 18 months, I think, really speaks to the business model, first and foremost, and to the strength of our customer base. Just to provide some perspective as to where we were to where we are today, If we go back to February of 2020, which was for us really the last kind of pre-COVID normal month of operation, we finished February of 2020 with cash on hand of 2.7 million, and we were in a 1.1 million debt position. If you obviously have looked at our results through June, we finished June with 4.2 million of cash on hand, and we have moved to a net cash position. And that's the first time we've been in a net cash position since the acquisition of Watt Bio late in 2018. We will continue to remain fully focused on cash management. It's embedded in the DNA of this business, and it's evident by the ongoing growth in Q3, upwards of 10% growth in both cash and our net cash position as we proceed through the balance of the year. The other slides really specifically product and service revenue analysis. As many of you have listened to us before, you'll recognize that the two bars on the left, or the four bars, it's really bifurcated down the middle. That's the franchise model, and that's principally North America driven, and it really speaks to the fact that our North American markets came back quicker and with more momentum than we did here in the UK and more broadly in Europe, as the lockdowns kind of extended a bit further in the UK and Europe. I'm pleased to say that Q3 we're seeing similar types of growth both in the UK and Europe, such that the mix geographically is becoming a bit more balanced. And I do like to call out the deferred income. We do have deferred income of substantial balance in excess of 2.5 million pounds of deferred income on the balance sheet. And that green bar, which is generally around £500,000, we take directly to income each year. The revenue analysis by region, I think it again just points to the different velocity of opening that we experienced in H1, with North America opening at a quicker pace. By default, the mix of revenue moved to North America. Generally, our business is about 50-50 North America to UK, roughly. And you can see what's happened in the first half is 59% North America, 39% UK. And that, again, is just a function of the recovery starting earlier in the US, principally. I think that more importantly, the message I want to deliver is as we're starting to experience better growth in the UK, obviously fully reopened, the mix will settle back to a more reasonable 50-50 or near 50-50 as we get towards the end of the year and certainly into the first part of next year. The last point I'll make is, and we've discussed this publicly before, and Jason will speak to this a bit further. We introduced the new Cyclone GRU unit at the end of last year. It's had very good initial success in the UK. And frankly, our goal was to sell it into Europe as well. And what you see in that far right is very early stages of the initiative, but we have sold a number of Cyclones into McDonald's in Europe. And as I said, Jason will touch on that a bit further. So from a more detailed perspective, just a couple points to pull out of the profit and loss for the half year. Again, revenues were up 17%, and that was despite ongoing COVID-19 impact, and that varied geographically, but we felt that across the business, certainly more in the first quarter than the second quarter. As you can see, quarter-on-quarter growth, so Q2 grew 29% over Q1, and we're seeing similar double-digit growth Q3 to Q2. So the momentum of the business, the acceleration of the growth of the business is getting back to levels that are more normal, more pre-COVID normalized levels. And that growth was really strong considering that on a constant currency basis, the strengthening pound versus the weakening dollar, on consolidation, we lost about 600,000 pounds. So against constant currency, you're looking at 10.5 million top line revenue, so the growth is closer to 25%. Under constant currency. Recurring revenue remains high. It's the core part of our business. It's the attractive part of this business model. and that is always around 80 to 85%. So that stayed roughly where it's been historically. Gross profit grew to just under 4 million, as I mentioned. Adjusted EBITDA, I think a key data point there is adjusted EBITDA of 1.3 million already exceeds by 23% the full year adjusted EBITDA in fiscal year 20. And then the adjusted EPS of 3.19, again, up significantly over the prior year, and it's really reflective of just the improved earnings in the business. From a balance sheet perspective, FILTA's always had a strong balance sheet. I spoke about cash management. This is a strength of the business. It's a cash generative business in a normal operating environment, and we're beginning to get back to that. As I mentioned, we've transitioned to a net cash position that will only continue to improve as we go through the balance of the year. There's not a lot of excitement on our balance sheet, which is a positive for me personally. The debtors and creditors balances, you may have noted, are increasing, and that's really more just a reflection of the increased volumes in the business. And I think the borrowings, just call out, what really comprises the borrowings on the liability section of the balance sheet is what's remaining of the term debt that we took out to finance the bio acquisition a couple of years back. And we did take advantage of a C-bills loan back in July of last year, and we've already made 3 payments against that on a 5-year repayment scheme. To the next slide on cash flow, the business continues to be cash flow positive. We were basically cash flow break even during the worst of COVID. Again, so I think that speaks to the business model. We generated more than $1 million of operating cash in the first half. And again, just a data point, that really represents nearly 80% of fiscal year 19. So a pre-COVID, a normal operating year, we've already generated in the first half of the year 80% of the operating cash we generated in all of fiscal year 19. We continue to focus on working capital management, and we've paid down close to 800,000 pounds of debt in the first half of the year. From a cash and liquidity perspective, I've touched on these. The only point I think I'll make is my final point is, we are and have historically been a dividend payer. We pay 1/3 of our earnings out in dividends. We generally do that 1/3 at interims and 2/3 at year end. But given where we are in the recovery, given the momentum that we are seeing, the board has decided to be prudent, wait for that acceleration of momentum to continue. But nonetheless, we envision that we'll be paying the full year dividend in early 2022. I will turn this back over to Jason.
Thanks, Brian. I see some of the questions coming in too, and I'll attempt to answer them as I go through this. So let's look at the geographic markets we're in now and how we're doing. So US based in Orlando, Florida, we only have 15 staff members in the States supporting 144 franchise owners who have 419 MFUs. The network revenue, that's our franchisees revenue in 2019 was $52 million. That reduced to 37 million last year, but we're now back to 2019 levels and beyond. We supported our franchisees by lowering their fees based on revenue that was down. Mostly, so we still have that program in place. We're probably 10% off now where it should be, and that program's finishing by the end of the year. The sector's recovered quickly, and our largest customers are only just coming back. The issue we have is finding the staff to service them. So, I'll show you a chart in a minute, which is our franchisees' revenues. We're back to pre-COVID revenue in the whole of the US. We added, I don't know if you remember from last time, we added about 1,000 sites during COVID. So they're now servicing those. And our biggest customers, the universities, are coming back this week and last week. And a lot of the sports stadiums are fully open as well now. So we're trying to get staff. We were hiring about 100 staff 2 months ago, but this is our franchisees. We've hired 2 full-time recruiters ourselves to help our franchisees recruit technicians. We're down to 45 we need right now. But it's the biggest bottleneck for us is finding enough good technicians in the US. The market here is tough for finding people for 3 or 4 different reasons. But generally revenues are back to pre-COVID in the US across the whole. Different pockets, California opened a bit later, but overall across the board, it's back to pre-COVID revenues. In the UK, we're based in Rugby, that's where Brian is today, 28 franchised units and 50 company-owned operations. Revenues are not fully back in the UK yet. They're close, as spending is still a bit tighter from the pub chains. So we focused on, during COVID, on supermarkets, on fast food, thinking that they would get through COVID better, which they have. The pub chains, which are our two biggest customers pre-COVID, are back, but they're holding a bit tighter on the finances. They're not back fully yet. So what we're seeing, though, is the water companies are now strongly enforcing the grease laws. We're seeing more fines to people, and we're working really closely with our customers to change to keep them compliant. So that's countering the lower spend. But really, it's come back better in the second half now. You're seeing better momentum in the UK than we saw in the first half. The new Cyclone GRU was specified as the only units used by McDonald's now, KFC, Leon's, Wagamama's, Yo Sushi. So those have been specified since we launched it just under a year ago. Does good work there. One of the questions I see come up on the screen is, what's the potential for this in Europe? We've installed a couple. Yes, we have. We've installed a handful of units in Europe. A couple of them are at McDonald's there. We've gone through the UK, guys, to get into Europe, and we're starting to do trials over there. So yes, there's good potential. It's early days, but we're seeing good results in Europe from that and other chains. So it's something for the future. We don't plan to put company-operated vans on there. It will all be done through our franchise owners there. So we would sell units directly, have them installed, and the franchise owners service them. So the potential is there, but that is for the future, really, for the business. We changed the model slightly in the UK to a more capital-light model. So we reduced our number of FOG techs from 23 down to 10. And we now have franchisees performing work on a pay-per-job basis in the FOG servicing. And as we grow the business in the UK, the plan is to expand it through franchising rather than through company-operated vans. In mainland Europe, we're focused in Germany. Significant potential, but we had severe lockdowns in 2020 and continued way into this year. We only had 3 staff members, so we've reduced the overhead until the macro picture improved. Pleased to say last month, so August was the first month all of our franchisees in Germany and Austria began to get the work back, which is great to see. And as I mentioned, we installed a handful of GRUs at key customers to enter the market over there. So again, early days, but it's something for the future. We've actually employed a guy in the States as well from the industry about 6 weeks ago, started with us to look at introducing the unit to the US. Once again, a long-term plan for us, introducing units in the States, but we're working on it now because the unit is very, very good. So we're focusing our efforts on the real growth now in the US and the UK. Let me just, North America. So this is our franchisees' revenues. So this is millions of dollars. So Q1 19 is by quarter. You can see it grew steadily through 19, Q1, Q2, Q3, Q4. As COVID hit, you can see the revenues tanked. It has come back. And as you see, Q2, good momentum coming off Q1 into Q2. Q2 was higher than Q2 2019. And we're continuing to see that momentum into Q3. And this is before our bigger customers have come back. So the States is really powering ahead. And as I mentioned, our biggest barrier to growth is finding good technicians at the moment, which we're helping the franchisees with. In terms of our market, currently service around 10,000 restaurants, 2,000 supermarkets, 1,000 plus hospitals, 300 stadiums, universities, a lot of this in the US. So we deal with Compass, Sodexo, Aramark, Centerplate, Delaware North. We're rolling out regions within Whole Foods in the States now. We just signed Guggenheim, which is I think the 5th biggest contract caterer in the US. So things are rolling in the States. In the UK, it's a more direct-to-customer model. We deal with McDonald's, Costa, KFC, Tesco's, Asda. As I mentioned at the beginning of COVID, we focused our sales efforts on customers we thought would be okay during the pandemic. So Tesco's, as supermarket chains, we've just installed our first 23 GRUs at Asda. We've just surveyed a whole load of Tesco's to get them compliant. KFCs we've got into now. We're the specified unit there. We weren't in there pre-COVID. So a lot of the effort's now paying off in those. Our two biggest customers, Green King and Mitch & Butlers, before the pandemic, are coming back more slowly, obviously, because the pubs were shut and they're coming back, but we're working closely with them to get them all compliant there. Aim to grow these by maximizing existing customer relationships by upselling products and services, which we do, adding complementary products and services, which we continually develop, and then we gain new chain customers. So currently have less than 2% of the market, so we're really aggressively looking to expand that now. A quick note on ESG integration. Our services at their core provide environmental benefits. In fact, for many years, we've provided our customers with environmental impact reports. In the next couple of months, in fact, the final meetings next week with the consultants, we'll be publishing a full ESG overview and reporting platform that will certainly show us in a favourable light. So as I say, the final meeting with them is next week. We've done all the hard work, ready to present in a couple of months, which is exciting. So a bit of a summary. The overarching message is that our industry sector is recovering quickly. We expect it to return fully by the end of this year. We're back fully, but not, every market's not back fully yet, but we expect it all to be back by the end of the year, and get into full growth mode next year. Margins have improved and we have the infrastructure now in place to grow the businesses quickly. The next 2 years is all about sales. The majority of our resources going into driving this. We'll continue to seek acquisitions. There is nothing on the horizon at the moment. We're pretty excited about the macro picture and the market conditions now for the next couple of years. So really that's the presentation. I will look through some of the Q&As.
Fantastic. And just while you do that, Jason, Brian, thank you indeed for that presentation. And ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. Just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that recording their presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the team, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Just on that note then, Jason, Brian, perhaps if I may just ask you to click on that Q&A tab and just start at the top, and where appropriate to do so, read out the question and give your response. Thank you.
I shall. So David S., you mentioned that current trading is now back up to pre-pandemic levels. Is this across all markets? Can you provide a little more colour? I think I went into that and tackled that went into the US, UK and Europe. Simon C., how much influence do you have on driving franchisees to grow their business? And could you expand in other geographic regions easily? So I think it's always a balance. The plus side with the franchising is the operational headaches are at arm's length. The franchisees have those, we don't. The downside is very difficult to put your foot on the sales accelerator because you have to go through the franchisees to do it. The flip side is with the company-owned operations we have. You have all the operational headaches, but it's easier to put your foot on the sales accelerator because you're selling more directly. So you have the balancing act there. How we've always sold in the US through our franchisees is we get some national accounts, which we continue to do, but we have an inside sales team. Right now it's 3 people who call into markets continuously on the phone to book meetings up for our franchisees with local potential customers, whether they are key accounts or whether they are independents. Now, right now our franchisees are too busy to grow their business with more sales. They've got too much work to handle. As I mentioned earlier, the price of cooking oil has doubled. And so there's a lot of demand for our service. And whilst it's hard for us to find good techs right now, it's just as hard for our customers too. So outsourcing the fryer management is becoming more and more required. So they're busy catching up with the amount of work they've got right now. One thing we've done though, in the inside sales, the telesales we have, as I mentioned, 3 people right now. We probably pay about $25 an hour for those guys. A friend of mine, I met him a few months ago, introduced me to running a telesales team out of Philippines. And into the US, a lot of Philippines do telesales here. So we hired 2 people with 15 years experience phoning into the US and did a trial with them for a month. And they outperformed our US-based people. And we pay them $5 an hour. So really, we have a platform now ready probably for early next year, once we've caught up with all the work and operational headaches, to maybe employ more people out in the Philippines, have our 3 in the US. Each of them has 3 people they work with in the Philippines to book directly the sites, so we can just chuck volume at the network. And our guys in the States really qualify the leads and deal with our franchisees. So we actually have a bit of a plan going forward for that, but we can't really implement it properly till early next year. So as soon as we're ready, we can turn that tap on, ready to grow. So we to answer the question, we have some influence over the franchisees, and it's really demand-led. If we create demand, we can help them grow. Andy M, next question. What are the drivers to growing US and EU revenues? Would you look to enter Asia? So the drivers for the US I just mentioned, very similar in Europe. We're early days there. The growth there is come through getting new franchisees on board. So it's all about franchise sales there rather than growing our existing network, because we don't have many people out there yet. But it's through national accounts there too. So we're driving national accounts. We've just signed a couple more furniture chains out there, and that sounds dumb, but like IKEA, there's many of those in Germany that have big kitchens. So we just signed a couple more of those, a couple more stadiums. So the drivers there are very similar to the US. Would we look to enter Asia? Not the direct franchise model like we have here. We would do Asia through master licenses, where we would sell a master license to somebody, and they would then sub-franchise in that country. Bear in mind, you need, for our core business, Filter Fry, you need people who fry a lot as a culture. And typically in Asia, it's a lot more shallow frying. It's getting more deep frying, but it's more shallow frying than deep frying. So really our core markets are US, EU and Europe and UK. Andy M, I think you said you were selling into McDonald's in the EU. How big is that opportunity in the scope in the US market also? So I kind of answered that earlier. It's early days for this. I would say the US market's different. The US market has, they're probably 10 years ahead of the UK. They have big grease traps underground built into every restaurant, as Germany has. They're passive, so they're not as good separating, but it solves a problem for them. But we're still selling units. So going into Germany, the interesting thing is our customers want our units because they can sell the oil, so it's actually cost neutral for them, but it stops a lot of the smell and stops the drains clogging between the kitchen and these passive traps. So it's more the market's more advanced in these other countries, but there's still markets for the product, and we are sort of establishing that now. David S mention made of staffing recruitment difficulties in the US. Has the group franchise experienced similar problems in UK, Europe? Not yet. The answer, we're not hiring as many people there, so we're not having the problems yet. In the US, we're hiring a lot of people. The US has come from a number of factors. The primary one being, so in states like I am in Florida, the state, if you get unemployment benefits, the state would pay $300 a month, a week, unemployment benefit for 6 months, then you've got to go get a job. They extended the time, quite rightly, through COVID because people can get jobs. But then the federal government topped up the $300 a week with another $300 a week. So these guys are getting $600 a week, or 30 grand a year to sit at home rather than go out and work. So that came to an end last week, and we're seeing that lighten the market, lighten the pressure on it a bit. Companies like Amazon, delivery companies, have scooped up a load of people at that operator type level, technician type level. So that's taken those out of the market. You've got people who don't still, unvaccinated, don't want to go out and into the market. So there's a whole sort of 3 or 4 things that are affecting it. We are seeing them loosen a bit now, and we put the resource in to help our franchisees with the volume of work, i.e. every inquiry. We put the ads in. We have people that respond to every single phone call. We phone these guys who are inquiring. Then we book them up for meetings with the franchisees. So that grunt work at the front end, we're doing all of that, and it's helping. It's helping release the pressure on the franchisees. Hopefully, sorry, to answer the question, we haven't seen that in the UK and Europe yet. But again, we're not trying to recruit 100 guys there, so haven't seen it yet. That's it. That's all the questions. I think I've answered them all.
I was going to say, you've answered every single one, Jason, so thank you so much for that. And if there are any further questions that do come through, of course, the team will be able to review those, and we will publish those answers on the Investor Meet Company platform. Jason, if I may, just a final few words to close off before we redirect the investors to give you some feedback, please.
I think, it's been tough since, COVID. It's been tough for nearly all businesses. If you'd have taken where we are now a year ago, you'd snap your hand off for this. And the momentum we're carrying into the second half of this year is strong, and that's the exciting thing for us. The first half was still, Q1 was still severe lockdowns in most of our markets. Came into Q2 expanding. We're seeing that continue into the second half, which is exciting for us.
That's fantastic. Thank you very much indeed. Jason and Brian, thank you both for updating investors today. Could I please ask investors not to close the session? You'll be automatically redirected for the opportunity to provide your feedback in order that the management can better understand your views and expectations. It's only take a few moments to complete and be greatly valued by the company. On behalf of the management team of FILTA Group Holdings PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Thank you and good afternoon.